So lesson 13.2 is going to be talking about recording the employer's payroll taxes. So there are several taxes that the employer pays. So we've talked a little bit about these first three: federal income tax, Social Security tax, and Medicare. Those are withheld from the employees, and they're put into those liability accounts until you pay them into the government. Then the employers also have several of their own taxes. The first two are federal unemployment tax, state unemployment tax, and then the employer also pays Social Security and Medicare. So we talked in chapter 12 a little bit about the fact that Social Security and Medicare are what we call a matching tax. So what that means is that whatever is withheld from the employee's checks, the employer also pays that amount in. So it's basically doubled in. And so if, like, for example, if they withhold $10 of Social Security out of your paycheck, your employer also pays $10. So it just matches it. So federal unemployment tax. Let's talk about that for a minute. A lot of times it is referred to as FUTA, F-U-T-A. That's how it's abbreviated in the business world most of the time. What federal unemployment tax is the unemployment system. So with COVID and everything that's been going on, you've probably heard a lot about unemployment. All of these people who've lost their jobs and gotten laid off are drawing unemployment. That's what this program is, the federal unemployment tax program. The FUTA rate in the book is 6.2% of the tax base. So similar to what we talked about in chapter 12 with the tax base, employers only pay on the first $7,000 that each employee makes. So that is the tax base. After each employee has made, an employee's made $7,001, the employer does not have to pay that 6.2% anymore for that calendar year. And then state unemployment tax is referred to as SUTA. So FUTA for federal unemployment tax, SUTA for state unemployment tax. And so this is how those work. So the FUTA tax rate is 6.2% of the tax base, which is $7,000 earned by each employee, and the earnings are subject to unemployment taxes are referred to as FUTA earnings. Then employers can deduct from federal employment payments the amounts that they pay to the state. So we have the SUTA, the state ones, and we have the FUTA, the federal. So it shows you here that the deduction cannot be more than 5.4% of the FUTA earnings. So the effective FUTA tax rate in most states is 0.8%. So if you look at this down here, federal unemployment is 6.2%. They take out the 5.4% that they can take out for state, leaving 0.8% for state unemployment, which isn't a lot, but it is still something. So here's an example, calculating unemployment taxes. So in this example, Gary Wells, prior accumulated earnings before this pay period was $6,490. So since the tax base is $7,000, he has $510 left that is going to be subject to the FUTA taxes. So when he gets paid this pay period, $1,444, you're only going to pay FUTA, the 6.2% tax for federal unemployment tax on that 510. So you basically are taking 7,000 minus whatever their accumulated earnings were, and that's how much more they have to pay taxes on. Now, had his paycheck only been $500, then he would still have $10 in the next pay period. And so if you look up here at Mary's already made $44,000. So there's no taxes being paid or federal unemployment tax being paid on her earnings because she's already passed that 7,000. And so that's how that works with the tax base. So in this example, recorded employer payroll taxes expense, $757.01 for the semi-monthly pay period. Taxes owed are Social Security, Medicare, federal unemployment, state unemployment. So when we look at this, Social Security tax payable This would have been what you withheld for the employees. This is what the employer is paying. Medicare, same thing. Remember, it's a matching tax. Then you have your unemployment tax payable and your state unemployment tax payable. Those are all going to be credits, debit to the expense, the payroll taxes expense. And so you do the debit, the memo, then you do your accounts that are going to be credited. And again, remember, these are the taxes that the employer is paying, not what's being withheld from the taxes, from the paychecks of the employees. This is all on the employer. So that's 13.2.